Welcome back. Welcome back, folks, to another episode. I had did a video on becoming a Chase Private client, and that video has really done very well for me. And I've been getting a lot of questions on if I can go a little bit more in depth on how the decisions that I made and how I was able to put together the funds and just give a little bit more clarity and detail on the process that it took from, where I was and how I truly became a Chase Private client. And so this is a little bit more on Aaron Davis and myself. This isn't really on Chase Private Client, the service, but how I was able to bring in and manifest the assets in order to be eligible to be part of Chase Private Clients a program. And so my name is Aaron Davis. Please subscribe to the channel. Give me a thumbs up for the video. And I just want to walk through with you on where I was. My story, my journey started back in April of 2018. And that's when I made the conscious effort that what I was doing at that time wasn't right. It wasn't enough. And I didn't want to continue living the path and the journey that I was on. So again, April 2018, I didn't officially become a Chase Private client until September of 2021. So that is a 3.5 year period, 3 and 4 month period. Yep, the 3 and 5 month period. And so I'm going to walk you through, the things that I learned, the things that I did, and hopefully kind of give you guys a different perspective. And maybe you're in your financial journey, wealth building stage. And what I did throughout this process, in addition to what I'm going to be sharing with you, is I listened to so many different people, and how they were able to acquire wealth, how they were able to pay off debt, things of that nature. And I just want to be another, cog in your wheel to hopefully provide something, open up your mindset to something different and give you another tool in your tool belt. There is one thing that I want you to get out of this, and this is a quote that I heard, is that your life truly does change when you begin working for your future instead of working for your past. And so again, when individuals having debt, things of that nature, that is, and you're paying off debt, you're paying for things that you already enjoyed, already did, whatever the case may be. But when you begin to invest and put money away for the future, that is working to be able to pull from in the future. And it gives you a newfound energy. So if you click off this video early, I hope you don't, but that is the one thing that I want you to be able to get out of this video. So let's get right into it. So as I said, I got to Chase Private Client in September 2021. And Chase Private Client, if you're not familiar, is a program where you have to have $150,000 in assets, whether it be investments, whether it just be in a checking savings account, retirements, 529s, little bit in all of them, add them all together, whatever the case may be. You basically have to have $150,000 to your name. Okay. Back in April 2018, where I was at that time is I actually had $100,000 in debt to my name. So I was negative 100 at that particular point. I had a business. I started my business, depending on, sometimes I'll talk, you hear me back in 2007 in high school, but I officially transitioned over to commercial in 2014. So depending on if you have been listening to a couple of videos, you might hear me go back and forth. It's not a lie, but 2014 is when I actually started having employees. 2007 is when I truly started the business. And back in 2018, I had revenue a little over $500,000 a year. My net profits were 7%. And I want to walk with you through the game plan that I used in order to pay off that $100,000 in debt and be able to accumulate enough assets to get into Chase Private Client. All right. So let's get right into this. The journey to becoming a Chase Private Client. So back in 2018, I started adding up all of my monthly debt payments, and I had a little over $4,500 a month that I was making towards debt payments. That was credit cards, vehicle purchases, equipment loans, personal loans, just a whole bunch of debt across multiple different fields. Some of it was, quote unquote, you could maybe say good debt. I don't think it was, because it was on vehicles and equipment that I needed to use in order for the business to make money. However, it was purchased irresponsibly and not at the right time. So I had $4,500 a month. My credit score was about 675 at the time. Nothing was really bad about my credit. However, I did have very high utilization. So across the board, I was right around 60, 65%. Some of my cards were maxed out. Some of them didn't have any balances on. I had cards that ranged from $5,000 to $25,000. So I was really close to about, between the business and the personal side, I want to say about $80,000, $90,000 in credit card limits. So I had a significant amount of credit card debt at that particular time. And so where my journey all started is I remember sitting in my office, and I wrote down two lists. I wrote down a list of all of the debt that I had, and I put it in order by lowest balance. So this card had $500 that I owed. This one maybe had $700, $1,200, whatever the case may be, from lowest balance to highest balance. Wrote one list. The second list, I wrote it by the interest rate that was on that particular loan. And so included in this credit card list was any equipment loans, personal loans, literally all of my debt, that $4,500 in monthly payments, everything was listed out. And then I did the same thing for the interest rate. And so typically I worked on the lowest balance first. That's typically. However, there was a couple times in my list where the balances were plus or minus $500 within each other, but this one had a higher interest rate. And so I actually started working on this one, or this was a fixed payment. And so, for instance, I recall I had my, one of my vehicles that I was trying to pay off, and I had a credit card that was about $2,000 a month, and then I had a vehicle that had about $2,500 left on that particular loan, and that loan payment was $300 a month, whereas that credit card was only like $50 a month. And so I actually skipped the $2,000 and began working on the $2,500 one, because when I paid that one off, I alleviated $300 a month in cash flow, whereas this one was only going to alleviate about $50, and as I kept paying it down, that monthly payment gets reduced. So I began to use some of these strategies to kind of figure out which way I wanted to pay things off and in the order that I wanted to pay things off. But again, typically I work with the lowest balance because I wanted to free up a payment. It provided some emotional excitement for me when one credit card got paid off. It was one less thing that I needed to worry about, one less automatic payment. I had a calendar, I recall, and on each day, because I had all these automatic payments and everything set up, I always knew which day a payment would be coming out of my bank account. And so if I could cross off one card or one loan, that allowed me to remove that one day off and not have to be able or not have to make that payment anymore. So that was really exciting. The next thing that I really liked with working on one credit card is because I began making all these extra payments to typically one payment. And so the credit card companies, what I began to learn is they actually really like seeing that. And I kind of did a double whammy. As I paid a card off, I would then go around and get a credit card increase to increase that credit limit, not to actually use it, but to help my overall utilization and begin to help pump up my credit score. So, for instance, the one that I said I had $500 left, paid that bad boy off. I don't even know what card it was, and I'm kind of making up the $500 thing, but whatever the lowest. And then I would go get that credit card, and then after card after card after card, my utilization and stuff began to get smaller due to the credit card or due to the payments or the limits being paid down, and then the limits increasing from the credit card increases. So, in addition to that, when I was working on a particular card, sometimes other cards will give me a balance transfer. So, depending on the situation and how close I was, I started having a kind of a snowball effect. Dave Ramsey talks about that a lot, in the sense of I started making these larger payments because more debt had gotten paid off. So depending on the transfer fees, depending on how long it was going to take me, I would sometimes move these credit card or limits or loans from wherever they were to a credit card that maybe had a lower interest rate, gave me 0%. And sometimes I even left them there because I was going to pay them off in two months or so. And so the amount of interest that I was going to be paying wasn't significant enough to take on the transaction fee that they were going to charge me to move that money over. So but the nice thing that started to happen is these balance transfers started coming up, and I was able to use these on some of the loans that were a little bit more on the back end of my list. So, I had a couple that were plus $10,000, and so, and they were at an interest rate. So I was able to take those $10,000 loans, move them over to a credit card, get that interest rate reduced, and just buy me a year. Cause this, as you see, from April 2018 to September 2021, was a long time. And so if those cards just stayed accruing interest and I was only paying the minimums on those, that was some cost savings in doing balance transfers throughout that journey. The one thing that I began to learn, and I kind of caught this on at the end, and I wanted to bring this up while I have a little note here for me, the balance transfer fee versus high interest rates. Discover does this a lot, where they'll send you two credit card or two balance transfers, one 0% 12 months with a 4% balance transfer fee, and another one that's 4.99% 18 months, no balance transfer fee. What I began to learn is that if you pay these guys off anywhere from 6 to 8 months, it is actually cheaper to get the one with the higher interest rate and no balance transfer fee versus the one with a 0% and balance transfer fee. And that's because you pay the 3%, 4%, 5%, Chase's 5% up front. Whereas with the other one, that's a 4.99. That's typically what I get from Discover right now. 4.99, that's over the course of a year. And so if you go 4.99 divided by 12, that's a little bit under 0.5% a month in interest. And so if you're paying these guys off in 6 months, that's 3%. If you're paying them off in 8 months, that's 4%. And so if you were going to pay a 5% balance transfer fee, it's actually cheaper to do the higher interest rate with no balance transfer fee than it is to do the balance transfer fee. So take that into consideration. Sometimes 0% for 12 months is not always the best option in paying off your credit card debt. The other things that I learned and what I focused on is, I paid off loans, which you kind of heard me say with that vehicle example. I paid off loans sometimes before I paid off credit cards because those loans had a fixed payment. And so no matter if that loan was $5,000 remaining balance or $100 remaining balance, that payment amount was going to stay the same across whatever that term was. And so it is more beneficial and alleviates more cash flow when you are trying to basically be able to move that cash onto the next payment that you want to start paying on. The next thing that really helped me jumpstart and accelerate this even faster is once I paid off my first vehicle, I realized that I didn't need to have full coverage on on that particular vehicle. And so that saved me from switching from full coverage down to liability. That saved me a couple $100 a month that I was then being able to take from there and move over onto my debt payment and my snowball effect. And so keep that in mind for cars that when you have loans on them, you have to have full coverage. So the nice thing for me was I work on cars a lot on the side, and so some of the additional work that needs to be done, I was willing to do myself and didn't need to pay for. And then also my cars were a lot older, so these aren't brand new cars. The cars and the trucks that I'm speaking of were all of my work vehicles. So these trucks were 10, 15 years old, and so the value of them was really only towards me and being able to do the work that we do out on the street. If I was going to sell these are anywhere from $4,000 to $8,000 vehicles, so these aren't very expensive vehicles. So I was willing to take the risk to only have liability coverage and not full coverage, but then take that savings that I was getting in order to when I switched over that insurance and put that towards the debt that I was paying off. I did do credit increases twice a year. I did in the summertime and I did in the fall time. I'll link a video up above here for you to see on a little bit more. I go a little bit more in detail on credit card hacks that I used to get myself from that 675 over to the 800 credit score. But I did do credit card increases twice a year. We really began to pump up and push up those credit card limits and use those credit cards as a self consolidation plan where I had multiple cards out there, 5, 6, 7 credit cards that had limits on them. And as credit cards began to get bigger and bigger limits and offer me balance transfers, I started reducing, 7 credit cards down to 3 credit cards so that then I only had 3 payments that I needed to make a month versus having the 7 credit cards. And then on my credit report, now I only had 3 credit cards with the utilization. Yes, they were a little bit higher, but then I had these other 4 that artificially got paid off because the balances moved over, and those were 0%. So that kind of is a trick to trick the credit bureaus. There's not going to be a major increase. It's not these 50, 100 point differences, but it is going to give you a couple points higher that I noticed. So the reason I bring up DTI all over again is because through this process I purchased my office, and so that really gave me a glimpse as to how how handcuffing debt can be in order to start acquiring assets and whatnot, especially if you're not on this $300,000 income. Debt is really, really, what am I trying? Debt really can hold you back. And so I learned through this process in trying to purchase a property that for every 55 cents in monthly debt payments that I had, I needed to have $1 in gross income. So it's a catch-22. Sometimes it's very easy to increase your income. However, for me and my business, the one thing that you have to keep in mind when you're going out to buy a home, sorry about that. Hold on one sec. When you're going to go buy a home is that they're going to be asking for tax returns. And so it is much easier and faster to pay off the debt because even if you increase your income, you get a raise on your job, they're going to take the average over 2 years. So you get a 10% increase this year, but they still look at last year and they just average those 2 years out. Whereas if you pay that debt off, there's nothing else for them to average. Yet also it's easier to pay off 55 cents in debt than it is to try to grow your income by $1 per month. So this is where I say it was more beneficial. Some individuals want to kind of bring all of their credit cards down equally or make, $10 overpayments on all these credit cards instead of focusing on one. It was much more easier for me to kill one loan, one credit card, one vehicle loan, one personal loan, and then start working on the next because that was also in accumulating all the documents and whatnot. I got a refinance video that I'll probably link up here too, on all the paperwork and things needed in order to refinance successfully. But then that's less material, less things that you have to explain. Why is this debt here? Where did that go for? Then if you're self-employed, at the beginning, I cross-mingled some stuff. So I had personal credit cards with business debt on it for vehicles for equipment and things of that nature. So it just was a lot harder to explain and a lot more minutia that I had to go through versus just paying that credit card off, not having them ask any questions and going on forward. So, focus on killing a credit card or a loan if you can. So the journey to becoming, again, a Chase Private Client, the light bulb really went off for me when I'm about halfway through. This is probably in 2020, but before COVID had all started. And I'm looking at my balance sheets and my cash flow statements, and I'm seeing, again, $4,500 of debt going out. And so even though by this time I had paid off some credit cards and things of that nature, I continued making the same amount of payments. And I just started pushing all of that money onto whatever credit card or loan that I was paying off. So my outgoing money never stopped or never went down. But I just noticed that all of this money is going out and I'm working day in and day out. I'm frustrated. I'm tired. I'm sore from doing, manual labor, things of that nature. And none of it is going to me. And that's where I said at the beginning of this video, if you're still watching, when you really realize that when you're working for your past, instead of working for your future, it starts to become a hindrance. And so that really was a cause of frustration for me. And so that just kind of gave me my last little jolt of energy to get through my last $40,000 of debt or so at January of 2020, February 2020. And so the question is, I finally officially got out of all of my debt in December of 2020. And I didn't really start investing until January 2021, so this particular year. And I don't know if I would change that or not. I ask myself this question all the time. Should I have taken some of that money as I paid a credit card off and then moved that money over into investing and then continued the debt payments down? But, instead of saying a payment was $50 a month, so the next month I only pay $44.50 and then $50 goes into investing and kind of lateral step it in. I don't know. I do like how I got out of debt. Because in doing that, it allowed me to have a smaller savings. It allowed me to have not such a big emergency plan because I didn't have all of these additional debts. It was pretty straightforward. Now it's gas, car insurance, utilities, my payroll. It's all stuff that is controlled pretty much by the income that I make. And so if I don't have the income, a lot of those expenses can come off. So I do think, and if I were to do it again from the knowledge that I do have now, I would actually pay off all my debt before I begin investing. But that also has to do partially with my age as well. If I was a little bit older, maybe I might change that. So you have to kind of look at your personal situation, kind of ask yourself, which route do you want to go? I don't know if any route is truly a bad decision, but I do know that having debt is not beneficial to trying to grow your assets, trying to purchase real estate, trying to invest more money, because it's just constant money that is going out, and especially if you're paying interest on that debt, it is just prolonging that over the months and over the years. The last kind of light bulb thing that I had was I became very comfortable with myself, and I think this is the one major lesson that having all this debt really did for me, and what I'm really proud about. I wouldn't advise anyone going through this process, but again, the one lesson that I did learn was, no matter how cool, no matter how nice of things people said you had, what am I trying to say? How much, what am I trying? I'm trying to say, like, there was many times when people would be, excited or surprised by hearing, how much money you make, things of that nature. But they were never there for the amount of work, the 6 days a week, the 12, the 15-hour days, the dealing with the different scenario situations, making the payments over and over again. And so no matter how cool or how much they helped kind of build up the self-esteem, it was still me that had to pay off the debt. And so I say all that to say is that even now with the things that I buy and the things that I want, I truly understand and make sure that it is something for me, because at the end of the day, it is myself that is paying those bills. It is not anyone else. It is not, others outside of my family that, or are assisting with any of that. So you learn to become very comfortable with who you are and what you want in life, because you learn that no matter how good or how bad it is, no one is there to, pay your bills. And subconsciously you understand that, because again, in your situation, no one's there for you. But in reality, sometimes, especially at the beginning, I would want certain cars for the status that I would get. I would want, to dress a certain way so that people would look at me. And that is such the wrong mentality and the mindset to have. And until you go through this self-cleansing kind of a situation where you realize none of that truly matters, it's really a nice thing to evolve into. And so again, I just leave you with, your life feels much different when you stop working for the past and you begin to wake up every single day and know that the money that you're earning is money that you can invest for your future. It's money that you can put into your college 529 plan so that they can go to college debt free. It's money that you're putting away for retirement so that when you're 65 plus, you got over $1 million in your retirement account, and you can live your life peacefully and ride out into the sunset. And so I challenge you, if any of you guys have any questions on your particular journey and what you're going through and some help, reach out to me. I'm always excited to talk finances and building wealth and whatnot. So, please leave a comment below. We'll contact. But again, my name is Aaron Davis. Please subscribe to the channel. Thank you so much. Bye-bye.